Sally Auld, Tim Lawless, welcome to 7:30.
Thanks, Sarah.
Thank you.
Tim, I'll start with you. How big a price slump is this?
It's pretty early, Sarah. Values are down about 2% since they peaked back in March, nationally that is. A lot more in Sydney and Melbourne. And that's probably the key thing here is there isn't really one national market, of course. Sydney and Melbourne peaked a lot earlier. Both those markets are down 5%. But we are now seeing it becoming much more geographically broad-based, with each of the mid-sized capitals moving into a negative period of growth.
So when the opposition leader calls it a collapse, is that the right word to use?
I don't think so. I mean, this is a very similar trajectory of decline we were seeing between 2022 and 23 when interest rates were rising off their record lows. It's a little bit sharper than what we were seeing back in 2017 to 19, but that was a more of a drawn-out downturn that was due to credit tightening rather than higher interest rates and some fiscal changes in the budget, as well as housing wasn't as unaffordable now then as it is now.
Sally, can I bring you in? Do you agree essentially with that version of what you're seeing, and how do you think it's going to play out over next year?
Yeah, that's right. So we're looking for, if you look at average dwelling prices across capital cities, we think the peak to trough decline will be in the magnitude of 7%. As Tim said, that's basically very similar to what we saw in 22-23. It's quite similar to what we saw around the global financial crisis. And I think, so far we're probably about, a little over a third of the way through that decline, and we expect that to continue through the rest of 2026. But at some point we do think, the market will start to clear again. The adjustment will be enough to induce both investors and owner-occupiers back into the market, and we should see prices stabilise.
So do you think some of the coverage that we've seen that talks about this as once in a generation, I'm not saying anyone's calling it Armageddon, but it's kind of getting there in the emotion of the language, Sally, is that too much? Is that misleading people who own homes or want to own a home about what's going on?
Yeah, I think that's probably overstating what's going on. And I think it's important to remember that the starting point for this correction was a really positive one. We'd had a very significant run-up in house prices over the last 5 or 6 years. Credit growth, so when we think about mortgage growth to both owner-occupiers and investors, was running at really strong rates of growth. Generally speaking, the household balance sheet is in pretty good shape, and as we know from RBA data, there's very, very few mortgages that are actually in negative equity. So if you were to pick a starting point from which to have a correction, I think it's a pretty good one.
Tim, just to understand how we got to this point, obviously there was a significant contribution from rate hikes earlier this year, but what impact did the government's budget tax changes make to what's happening now?
I think it's definitely amplified the downwards pressure we're seeing in housing prices, but even pre-rate hikes, we're seeing the market slowing simply due to more, natural factors like affordability and serviceability factors. We're starting to block more people from participating in the market and skewing more demand to the lower price points, which was actually quite competitive with more first home buyers taking advantage of the deposit guarantee from October last year. So I think interest rates absolutely are probably the biggest factor here, and then amplified by what's likely to have been a fairly sharp pullback in investment activities since the budget was handed down.
Just talk about that, the government's 5% deposit guarantee. Was it the right move, and was it the right timing for that move?
Well, I'm never a fan of these demand-side stimulus policies unless they're accompanied by some sort of supply-side initiative. And I think it's also fair to say the timing was probably reverse. Ideally, you should have waited for the housing market to move through a correction and then incentivise first home buyers to come into the market, whereas this was the opposite of that. We've seen first home buyers come in just ahead of the market moving into a downturn where housing prices were falling. So it's probably fair to say there are a growing number of first home buyers that took advantage of this program that are seeing values now lower than what they paid for them and potentially lower than what their mortgage is.
But is that something that the banks are really concerned about? I think Sally just referred to it being, it's not an extraordinary number in historical terms.
No, absolutely not. And I think it would be more of a problem if we had a much looser labour market, for example, or the economy was going in reverse. I think most first home buyers who might be in negative equity, they probably don't even know about it. And time fixes all wounds. They'll probably move out of this because people hold their property for a much longer period than this downturn is going to last.
One question for you, Sally. Is the super cycle of making money out of housing coming to an end in Australia? Those decades that we've lived through with those crazy numbers of house price increases, is it over?
Yeah, so I think there are a couple of things around that story. You know, one was, as Tim mentioned earlier, we were pushing up against pretty significant affordability constraints already in some of the bigger capital cities. And so I think that was probably already going to act as a bit of a handbrake on the housing cycle. I think what's important is that the taxation changes that the government announced in the budget really sort of flip, I guess, the emphasis for housing investors away from the capital gain and much more towards the cash flow associated with owning an investment. So to that extent, they really remove the focus on the capital gain. And so I do think it's probably fair to say that we are now in, I think, for a reasonably long period where the sorts of capital gains that we're used to seeing in the Australian housing market are probably likely not to eventuate, and we should probably, I think, expect that housing, over the long run will still be an asset class that performs well. It's just that the magnitude of those increases, I think, is going to be lesser than perhaps we've become accustomed to.
So what would be the impact if the opposition carries through its pledge to reverse the negative gearing and capital gains tax changes?
Well, I think that would induce investors back into the market, right? Because we go back to that pre-budget taxation environment where, for most investors, effectively, the taxation of your capital gain plus the combination of negative gearing meant that there was a nice incentive to leverage into an investment property. You didn't have to worry so much about the cash flow. And you really just sort of focused on the capital gain. So it would really just be, I guess, a bit of a back to the future. We just go back to where we were with housing now becoming, far more attractive for investors.
Tim, is such an outcome desirable?
Well, I think it certainly takes away from the certainty that investors are looking for. I agree with Sally. It probably would attract investors back to the market, but it's got to be a pretty big blow to confidence if you're seeing taxation policy following the election cycle. I think that would probably ultimately see less investment in the long term, given it's a changing playing field every 4 years or so.
And where we are at the moment, are we looking now at a deeper shift where Australians start to think more about housing as a place to live rather than, less as an asset to trade? Is that an evolution that is taking place?
I think we're in the midst of that now, absolutely. And I think, as Sally said, once you take away some of what you might describe as a crutch for property investment, being the negative gearing allowances, it just doesn't really stack up as well as it used to. And I think you'll start seeing people do view property more as a roof over somebody's head rather than an investment class. Although I still think we will find there's going to be some level of investment in Australian housing.
Sally, just to finish up, to conclude, who are the winners and losers from the current situation?
It's a good question. I think over the long run, it's really probably owner-occupiers who are the sort of winners in all of this, in the sense that we're going to redistribute, I guess, the ownership of housing in Australia away from investors and more towards owner-occupiers. I think, you, as a property investor, you still have access to your choice of capital gains tax regime and negative gearing if you want to buy a new build. So I think it's not like we've completely cut off that avenue for property investment. That's still very much open, but it's just really, most people living through what we think is going to be a reasonably sized, reasonable duration adjustment in house prices, something that we expect is going to run for the rest of the year, but the market will be efficient and we'll find a clearing price, we think, probably in 6 to 9 months. And then, it's quite possible that prices will start to gradually go higher again, but I think we just need to become accustomed to the idea that we're not going back to a world where we get these supersized gains in house prices in short periods of time.
And Tim Lawless, just to finish, do you agree with that? Where are we if we're sitting here in a year's time?
Yeah, I think we'll probably find a year from now the market's probably bottoming out. Interest rates are starting to come down, inflation's under control, and we probably will find more first home buyers are active in the market, partly because housing prices have come down and there's less competition with investment. So that's kind of the grand plan here. But also you'll probably find that rental markets are going to be very tight. And this is probably the wild card for this policy is how do rental markets perform after this? We really need to have a plan B for getting more rental supply into the marketplace if we don't want to see renters facing ongoing hurdles around rental costs.
Thank you very much indeed. Tim Lawless, Sally Auld, thank you very much.
Thanks, Sarah.
Thank you.